All right. Good morning, everybody. It's going to be an interesting week. So far, we are looking green around the world. And if you look at this post, it just came out on Finance Juice. It has a list of cuts and probabilities around the world. It's worth taking a look at that and to circle back to what we've looked at before on FedWatch. There was a post right before this one had come out talking about how the market seems more confident in the Fed's position now. So throughout the week, this week, we're going to get a lot of Fed speakers, and we're going to look for that to be increased even more. Remember, it's all about the messaging. Stocks rally as confidence in Fed wagers grow. Now that's the European wrap, but there'll also be a morning briefing that they post. They do that for all markets that are about to open, and then they do a market wrap, which is a finish up of markets, usually after they close, but they do Europe's wrap early, even though they don't close yet for a couple hours. They just do that to help us out because they know, US is coming online. These auctions are likely to be pretty impactful this week. They're going to reflect, how the QRA went, right? These auctions, a lot of times they don't really have the impact that I would like to see with these auctions, but I always want to pay particular attention to them. It seems like a lot of the times I'm the only one ever talking about these auctions, but you do want to know where they're at, when they're at, and watch the clock. So today we've got two Fed speakers in the afternoon. That's the only two that are showing up on Market Watch. But if we look at FX Street, we got front end auctions. These aren't the ones that we want to be too concerned about. Every auction is worth paying attention to. I would never discount any data or tell you to ignore data. But these aren't as big as what we're going to be getting this week. The 10-year, the 30-year, I mean, those two, kind of a big deal. But one day at a time. We've also got some markets that are closed. And remember, if you are unsure of markets that are closed, if you think they're open or you're just not sure, you can check. There's a website called tradinghours.com. You don't need a subscription to it. It's free. And you can see which countries are open, which are closed, why they're closed, what holidays they have, whatever. And it shows you the time zone so that if you want to, you can set your Thinkorswim charts to that same time zone just to kind of understand. As you can see, we got a full list for earnings this week. And just like with the auctions, I wouldn't discount that we're going to have earnings this week, but these aren't the big ones, right? So they still matter. They're just not big enough to take down the market by themselves. All right, this is a weekly chart on the ES. Down below here, we got the CVI. This is cumulative volume index. Think of it as net buying and net selling. Now on Thinkorswim, we have to pick which index we use. But if we looked at this on TradingView, we can look at the CVI and look at all markets. What we want to look for here is divergence between what price is doing and what volume is doing. Can you see the divergence? This is the daily chart. We set a high in price way back here. Cumulative volume wasn't done. We still had net buying all the way up until here. Then both of these took a pullback, but cumulative volume was already on the way back up starting here, even though price continued to the downside. This has made new highs and is flattened out a little bit, whereas price is still sitting way below this low, this high that was set back in March. So this is bullish divergence. It is all of the US markets. So if we wanted to be more particular, we could go in and, look at just the NASDAQ, just the NYSE, but net buying and net selling, basically what cumulative volume it's wrapped up to be. Now, back on Thinkorswim, with just looking at the NASDAQ on the weekly, we're not sitting at new highs on this indicator, but we have had this nice run up, kind of flattened out a little bit. It's not against the top of the Bollinger, but it is against above all the moving averages, even though they're kind of tangled together. Now, we've had a lot of talk in the last week or two about pure price and topping patterns. We had a really good pullback to the 20-week. It's holding reasonably well. We've run back up and we're kind of testing against that 10-week, but we haven't fallen away from it. So on the one side, we're under the 10, that's bearish. We need to get back above it. And the fact that it hasn't fallen down kind of reinforces that idea that the market is bullish, that it wants to get through here. But at some point, if the market continues to struggle and it doesn't get the results that it's looking for, it will just wash everything out and start all over again. As you can see, we're above the halfback, 50.88. We've got to get above that 52.11 cog line if we're going to challenge this high back here. If we were using OCR, then we've got higher high and higher lows, higher close. So it's a good start. But we're still like in a wedge shape. And we still don't have definitive answers. It's still just a topping pattern. Now, bring it over to the daily. We got that higher high and we have that higher low. But here we're struggling with the 50. We need to get back above it. The 10, the 20, they're not useful here. They're just all tangled up. There's no value in them. Right now, it's just all about that 50. So let's get through this 51.71.5. Very likely it's going to digest that for a little bit. We could even pull back. Then above that, we'll start to focus on 1.5. Which should get us up really close to 5,200. So that's the measured move from this really big bar on the 30th. And it's all still a part of the idea that this is just a complex topping pattern and that we still don't have an answer on should we be bearish or not. If you come back and look at old examples where we were under the 50, we tested against it, finally got above it, that didn't save the market, and we still ended up washing out, breaking this low and going lower. So we still don't have, clear guidance on what we're going to get going forward. But I am more bullish than bearish. We just have a lot of data still to work on. We're inside a week breakout. We're through the previous week's high. We're also through Friday's high, which they're the same thing. Now that we're out, kind of want to keep it. We gapped up and ran outside of it last night, came back down, and have come right back up again and broke out again. That's one more check mark in that bullish behavior. Running well above the VWAP. Everything is looking really good. Volume's a little light, sitting in at 56. But with a couple of markets closed, the lighter volume kind of makes sense. We don't see a market maker move, so this lighter volume isn't too concerning. It's a little off-putting to see the volume so light, but we know about the markets that are closed, and there's a lack of market maker move. So, it's not like there's some imminent threat that we need to be overly concerned about. We have an MDP, that's a missed daily pivot. So far today, we haven't hit it. We're above the 10-week. Let's get to, yeah, something nice and clean like this. We're kind of sitting in the middle here. We're not overly close to one side or the other. Sure, we could argue that we're closer to the upper edge than the lower edge, but not substantially more. All right, it's not like one of those mornings when we come in and we're hovering right underneath one of the ADR levels. That's a good point too. We're above the 3-day door. Day one or 3-day, either one, we're above it. So normally we get a little bit of a tell from the ADR levels. If we're closer to one than the other, then we kind of, look to close that gap and tag it. But at this point, we're still sitting in the middle. And there is a statistic that I continue to keep in the forefront of my mind just because of how neutral it is. It's just it's a shocking number. In the first 30 minutes of the market open from 9:30 to 10, the market can change direction from, being overly bullish to bearish, or vice versa. In that first 30 minutes, it can do that 50% of the time. So no matter how bullish we are going into the open, or no matter how bearish we are, no matter what the pre-market looks like, what the news is, what the flows are, it doesn't matter how much bearishness or bullishness there is, there's still a 50-50 chance that we're going to flip and change direction within the first 30 minutes of the day. That's a shocking number, that it's an impressive number, really. And I keep it in the forefront of my mind a lot so that I don't get overly confident about having an idea about my bias where I think the market's going to go. Right now, we don't have any edge in trying to pick which one of these red lines we're going to hit today. And it doesn't have to be an either or thing. It's not like if we hit one that we can't hit the other, right? We can certainly hit them both in the same day. That's no problem. But generally, we want to start with the idea of looking for which one are we going to hit first. Since we already, for the second time, have got through yesterday's high, and we are slightly closer to the upper one than we are the lower one, it's pretty safe to assume that we're going to hit the upper one first before we even consider hitting the lower one. I will change my mind on that if we break again back down inside of yesterday's price action, which is also last week's price action, right? Because we're inside week breakout. So as long as we're holding above that, I'm going to aim for the upper ADR and expect price to remain relatively clear with its VWAP. If you look at how it's doing so far today, getting a little extended. We'd want that cleaned up a little bit. We don't want it to outrun VWAP too much. So maybe a little bit of a pause, some digestion. The kind of a threat here is reciprocation. If we get too far from VWAP and we decide to come back, then we could take to the bottom whatever we got from the top. And that puts us somewhere close to 51.50. Not the kind of way I want to start the week. And speaking of starting the week, gapping up on a Monday in equities, I mean, that's pretty bullish. I like it. In the futures, not so much. I'd rather gap down on a Monday if I'm bullish. It's a little bit of a bias, right? My own personal bias, but there's different kind of gaps, right? So that's something to keep track of. There's exhaustion gaps, breakaway gaps. Well, there's like we call gap and goes. There's, event gaps like earnings and news. So not all gaps are created equally. The thing about this gap that's kind of bugging me is that if we gap up on this Monday, it's not like we came down to a low and gapped right there. I mean, there's a really good one right there. That was a big gap jumping through this resistance. And just imagine how bullish that looks, right? On this week here, we had came up to that liquidity zone all the way down and came all the way back up and closed. That recovery back up was already bullish. And then the massive gap and the run with almost no wick on the bottom of that week. It was just bullish and it kept it. Same thing back here. No wick on the bottom of that week. It was bullish and it kept it. So when it comes to a weekly close, when we get one of these weekly breakouts, where it's at kind of matters. I don't like them when they start demonstrating weakness right away, like this one. We gapped up, that was red to green, looks really bullish, but closed down on the week, had a lot of wick to it. So far this week, we didn't get much of a gap either. I mean, this is a minor gap compared to some of those that we just looked at. And it's already closed the gap. It's already faded down. And now it's run back up. Not overly inspiring a lot of confidence here. There could be a bit of a bull trap, but if we discount the moving average completely, I would focus on where these halfback levels are. And as long as we hold above that, then I would just say it's got that bull strength instead of a bull trap. We're above the zero gamma and the volatility trigger. We have an MDP. We're above the weekly pivot. Everything about this market this morning looks good, healthy, bullish, strong. And the discussion about the market accepting the Fed's narrative, plus we're going to get more of that Fed narrative this week. I think the only thing that could derail this kind of warm, fuzzy feeling would be if the auctions are out of whack. So that's something we want to pay particular attention to this week. We're going to lose volume in this volume profile along the bottom today. So unless we continue expanding to the upside, this range is going to contract through the day, and it'll be even narrower this morning, tomorrow morning, by the time we come in. So we want to see this expansion continue. If we can get into 5,200, that'd be a good start. All the volume is in the upper portion of this 10-day profile too, and we are above it. Kind of like the same concept of yesterday with Friday. It's a classic P, and all of the volume is in the upper part. So we talked about staying inside day breakout, that we want to keep this breakout. That's even more important when we think about the point of control. If we do break down inside of Friday's range, we want to see this point of control hold, and it looks like it's already been tested once. It's a VPOC, so as long as we haven't broke through it, it's still VPOC. That should get us lined up. There we go. 155, 156. It's close enough. It won't matter one way or the other. We can see that it was touched. We didn't breach it, didn't get below it. So, it's supposed to be untouched completely. It shouldn't even have been hit. Otherwise, we wouldn't count it, right? But I'm going to leave it on there. Just in case we go back down today, I want to know where that level is. That's a lot of unfinished business. So I already mentioned we should keep this breakout, right? We don't want to give that back. We've already came back inside once, which was an indication of weakness. We don't want to see that twice. The thing is, even if we do, just because of gyrations, we're coming into the open, we're going to get some volume, we could duck back down there. It's fine, right? It's a little bit of gyrations. We definitely don't want to see price get below that VPOC, because then that changes everything. It puts that old support over our head as a resistance, and now it's just going to be one more thing in our way to stop us from trying to rally out of this. So we definitely want to keep above that level. If we do break down under that level, then mark out all of the RTH from Friday. That'll give you a half back to focus on, and then do, the entire Friday. That's a different half back to focus on. And each of them have projections too for upside levels. 5,200, well, we already know that the round number was going to be a liquidity zone, but 5,186, also a level of concern. So last week, we looked at the expected move projections, and they were smaller than the week that we had, but they didn't count, right? We did that Friday morning. We measured this zone, and it was smaller than the current week that we were in, but it only counts after 4/15 Friday. So we got a new week. The box is set. We can now measure it to last week, and we can see that the week that we're in now is lower in volatility than last week. And that makes sense. We're through a lot of the events already. So many major bricks in the wall of Warrior gone now. We're done. The market likes drama. It's going to find something else to be upset about and focus on. For the moment, that's going to be the auctions and listening to all these different Fed speakers. And you can see it just by looking at the headlines that are coming in from places like Finance Juice. Finance Juice is an aggregate news service. It collects news from different places and brings it to you. The topic that all the different news agencies are hitting on is the Fed, the auctions. So that's what we want to continue to lean on. All right, this is US dollar Japan. You can see that really sharp pullback after it got into 160. They did multiple interventions, but remember what I've said, this isn't the one to watch for by itself. I mean, it's always good to just keep your eye on it, but if you're looking for whether or not they're going to intervene, try to keep your eye on Japan's 10-year. We can see that their intervention isn't working. Sure, on US dollar Japan, we're down from that 160. It looks good. It looks like the threat is over. This, on the other hand, does not look like the threat is over. All right, that's sitting up into some serious territories. Now I'm on a weekly chart. So this high here, that's from last year. That's QRA of November of 2023. So kind of keep your eye on the news when it comes to Japan. Pay attention to when they have economic data sources. Find any articles, that talk about what's going on with Japan and treasuries. Take the time to review it because this still is a serious threat. All right, for the 10-week, we are back above it. So far, it's looking good. Just keep in mind, we've had these long periods of time where we get below the 10 and we come back up and we're not able to keep it, right? And we come back down again. If we look at that time frame on the chart, it's where we had set a high and then we started setting all these lower highs and lower lows. Broke the 50. We were trending to the downside cleanly underneath the 20 and the 50. So we're still in a situation where there's that kind of threat on the horizon, and it will be until we can finally clean all this up and get through it again. We are back above the anchor to VWAP though. That's year-to-date anchor to VWAP. So that's a good start. And we're 1% above the 10-day. So when we think about being overbought, oversold, having moved too far, too fast, and being owed a pullback, we're not there yet, but 1.5% from the 10-week or the 10-day, excuse me, is about where we pause. We've been doing that all year this year. Now, in previous years, we've gotten farther away, but this year, that's been our average, is around 1.5%. And really a bit less than that. I mean, there's the high that was set at 1.4, or maybe this one 1.44. Maybe the average is a little less than that, about 1.25. So we're near the point where we would expect price to pause and let the 10 get caught up to us, which is a way of correcting, or of reversing and going back to that 10 and correcting that way. Close, but not quite there. If we get another big day where we move really fast, then we'll be short-term overbought. So after a week of waiting on the Fed and then getting the data and getting some movement, we want to look at the broader market and ask, how's that doing? Has it moved too far, too fast? Is it overextended? Is there any room to run? This grid seems like a lot to take in, on first glance, if you haven't looked at it before. The top three are our risk on markets, bottom three are risk off, and the mid three are midline markets. So we got, staples and healthcare, utilities on the bottom, with consumer discretionary, technology, and financials on the top. I got this label in the corner of all of these showing the 5-day change, basically how it did last week. And we want to look for things that are, more than 4%, 5%, because these are sector ETFs. They're not, FANG stocks and magnificent sevens. We don't want to see 5 and 8 and 10% moves in a single week on these kind of names. And you can see that there's a lot of room here for these to make some moves. XLB is basically flat over the last 5 days. We didn't do anything. Same with industrials, flat. We didn't do anything. Some are down moderately, like financials, less than 1%. And some are up moderately. Consumer discretionary, up 1%. The ones that are really kind of stretched, I guess if we want to consider it that way, would be energy, more than 3.25%, and utilities, more than 3.25% in the other direction. So I do like extremes. If I was looking for things to change today, it might start with long energy and short utilities. And it doesn't have to be these ETFs, right? You can open up XLE and look at the names that are inside there, which names would fit my trade style. And the same thing for utilities, XLU. We don't necessarily have to trade that. We can open up the ETF, see the names inside of it, pick something that perhaps fits me better. And that's what I would recommend, right? If you're looking for a start, and that's more than just a day trade, we would be expecting at least a short-term trade, 5 days, 2 weeks, just a bit of a turnaround. But I would approach your time frame with a little bit of caution, because we are just talking about a little bit of a turnaround. not a change in market dynamics. For the ones that are flat, like industrials and building materials, those names could be ready to run, right? And they're sitting right at the starting line if you want to think about it from that point of view. I like using the basketball analogy. They are right in the center of the court. They could move either way with a clean shot in either direction. So plenty of room on both of those spaces too. And then continuation on the ones that are less than 1%. So like financials, they're not down enough to expect some kind of mean reversion, or staples and healthcare, they're not up enough to expect some sort of mean reversion, maybe a continuation. Nothing is down enough to meet our benchmark qualifications of 0.5%. But if we look at what's up this morning, what's that? Bitcoin, nat gas, gold miners, energy. Imagine that. Biotech, banks, uranium, more energy, financials, and semiconductors and the Mag 7. There's others that are up. They're just not up enough to meet our benchmark, our qualifications. We need that 0.5% at least. Now, some analysts will use 1%. Since I do the morning briefing so early, I don't use that 1% qualification. But if you were doing this on your own, you certainly could, because you could do it later in the morning, right? It's like closer to 9 o'clock. Asking that question of what's up this morning, what's down this morning, and use at least 1% as your line in the sand. China's not up. That's a little interesting. One name that wasn't in the list on the other broker is pot stocks are also up this morning. Now, Bitcoin is a representation of risk, right? It's like that. It's like the riskiest asset that you could focus on. And when we see that up, we consider speculation is up. People wanting to long the market and take risks, and it's just a good sign of liquidity. So Bitcoin being up this morning, that's a good thing. We don't want to see it get too overextended, and you do have to keep in mind that it moved a lot over the weekend. I don't know if you guys keep your alerts on over the weekend, but one of the alerts that I kept getting all weekend was on this. It was on Bitcoin. So after it already made a move all weekend, it wouldn't be at all surprising to see it now top out a little bit from its weekend run. Plus, we're right up into a liquidity zone anyways. So if Bitcoin pauses here, then a lot of those Bitcoin names, Hut, Hive, Mara, MSTR, Riot, we might see those pause too. A pause isn't bearish. It'd just be a little bit of a timeout. They already had a big move on Friday. This is BITO. That's a big gap up. And so far we're keeping it, but there's still a lot of resistance overhead, and it's just one name. And there's a lot of them. And look at the a bit of a rollover already this morning too. So I would approach those bullish Bitcoin names with a little bit of caution and just keep your eye on them. We would expect them to pause, consolidate a little bit, pull back some. That's not a big deal. We don't want to see a breakdown there, right? Like crashing and burning in Bitcoin is not going to be good for the rest of the market. So weakness would be all right today, just not, some real nasty pullbacks. Silver, gold miners, precious metals. We got that inside day breakout, really nice gap up from last week. And we got this gap closed, although a lot of analysts will say a gap close in the pre-market doesn't count. Also, some analysts will consider the candle that we closed at and the candle that we opened at as the gap anywhere in that candle. And I'm not that way. I'm a bit more particular. To me, a gap is only closed when we get back to the place where price closed. So this morning, we're up to that level. The gap is closed, but it is pre-market. Some don't count that. And if we fade out of that spot and fade down from there this morning, then we're going to need to get back up there and hit it to consider it a gap close. Otherwise, this is a really nice island reversal where we gapped down, spent a few days there, and now we've gapped back up. If you've read the book Hit and Run Trading 2, I think it's 2, where they talk about Gilligan's Island and a bearish and bullish Gilligan's Island, could be having that set up this morning. Otherwise, it's also a TRB setup, trendline breakover. I don't think we could make that move in a single day, but it'd be an interesting run to get back up to 26.5. This is crude, and there's still a lot of work to do here. I mean, even if we were looking for a turnaround, there was that head and shoulders here. Looks like that measured move is done, at least part one. And as long as we don't break last week's low, then we could base here or start to run back up. 77 is the area we'd want to get through first, just our line in the sand. It's almost the midpoint for this breakdown candle on May 1. Yeah, I know they come up with some funny names, don't they? The book had some really funny names to them, to all these different strategies. I'd want to get through this halfback, that's $77 first, and then start working on the bigger picture. 79.5. But one level at a time. Let's just keep this base first. Try to turn things around and come back up. I guess I should have moved that low too. There we go, 79. So 77 and then 79. Silver's got a really nice TRB as well. And same thing, right? That collection of 4 candles, we've gapped up outside of it. It would be a really nice IX10, but it was just too wide. That island down there is just too big. So it's not representing any sort of compression or anything like that. All right, Microsoft's just continuing that move from Friday at the open. We had that big pop up, and then it just really nice grind. The thing is, I mean, that's almost a textbook bullish pennant, right? And from that, we should have popped up strongly and made another leg up. And instead, we got this kind of trickle flow higher, like a grind higher. That's not inspiring for, bullish confidence. All right, so this is Microsoft on a daily. $409.5. It's kind of a big deal. The the issue right now is that lower high, breaking that low, getting this newer low, this lower high, and another low. And right now, this big unknown. We're up at 408.40 this morning. So we're already close to that 409. If we're going to set a lower high, rejecting off the half back would do that. And what we end up with is that lower high, and then the idea that we can come down and break that 389 and set yet again another low. Otherwise, if we break that 413, then we've got more room to work with. Let's just get above that 409.5 first and keep it. All right, on the weekly, Google looks good. We need to stay above this 162.80. Just call it 163. Or you could look at it and say it's last week's low. We need to stay above last week's low. This morning, we're barely gapped up another 20 cents. So it's not really all that up or down yet. When we look at it on the daily, you could see this kind of a pullback. That's not really too big of a deal. It had earnings, had that big gap up, and it faded back some. All of that looks fine. It's It's not a big deal. But now that we've established this base, this low needs to hold. Plus, it was the half back anyway, so now it really needs to hold. We had a really nice recovery bar on Friday, and sure, we closed red, but we closed inside day breakout after having opened, gapped up above Thursday's level, fell all the way down, broke out of the bottom of Thursday's level, and then ran all the way back up to close higher than Thursday's level. I mean, that's pretty bullish, but it needs to follow through. And this is a really compact TRB setup, but it also forms like a bit of a scoop pattern. And that would be like a very small cup. If we do or we don't get a handle is secondary to the idea that we can make the top of this in a single day. That's a TRB setup. We want to focus on getting inside this channel and then getting that gap closed and then getting to the top of this, right? So level by level, we get through that open and break above that day. Then we focus on that close and then the high and getting above it. It can make the TRB run in a single day. So getting up above 174 today is absolutely doable. But it doesn't owe us that. We could just chop down here some more and continue to work on this base because it was a big move and it does need to kind of digest that some. I just like that recovery from Friday. That's a really powerful signal. Amazon's basically flat this morning. It's not really gapped up very much. It closed at 186.21 and we're at 186.31. So, you know, it really hasn't done anything. But after that big gap up on Friday, even though it closed red, it still closed higher than the previous day's close. I would look to see if there's more liquidity here. You should be able to see it every time we get up into that zone. See it on the dome, level 2, time and sales. Just look for that liquidity to show up. Are the sellers done? Are they going to stand aside and get out of the way? And then, of course, can we break through and continue above that 190? So right now on Amazon, just staying inside of last week's candle, not breaking underneath that, is all the line in the sand that we need. But that's a lot of room. That's a couple of dollars. If we do break that low, then we'll focus on the day before, 184.72. So Bitcoin, precious metals, energy, and pot stocks. That's not necessarily the kind of bullish backdrop that we want to see. But if we think about that rising tide, we're kind of looking at it. We have everything except the Mag 7. So if we get that too, it could be an absolutely amazing run day. And we can see it. Look at the NASDAQ stalling, really struggling to get that breakout here, while the ES has already made that breakout and is continuing to push higher. Normally, the NASDAQ would be, you know, in the forefront of this sort of a move, and it's dragging its feet because it doesn't have that Mag 7. 10-year setting these lower highs. We need new lows though. Get outside of yesterday's low and continue to move to the downside. Got the Dixie fading a bit here. Also setting those lower highs and lower lows. But this isn't bearish yet. It's not bearish enough. Let's get through the half back. After we do that, then we can focus on getting through this structure here, that 104.5. Or I guess it's 104.75. Get through that and then 104.5. Bonds looking good. They're not bullish enough though. We need that inside day breakout in bonds, a nice continuation, some accelerant. And US dollar Japan pulling back a bit more, which is good. It's like we talked about, we want to see that, but we need the Japan's 10-year to make some moves. And right now, that's not the move we want to see. We want to see this pull back, fade down, not gap up and go higher. Keep your eye on the clock. Look for the Mag 7 to come in and assist this rally because we've already got so many other spaces that are bullish. If we get the FANG stocks to come in and help, oh boy, that'd do it, right? That would do it. Be careful, be safe, have a good day. I'll see you all tomorrow.